I'd very much like to be served this glass of wine. But because I'm getting older, perhaps, I'm just a little bit sensitive these days about people knowing my date of birth. Is there a legal way? Is there any way for you to discover if I'm of legal age to buy this alcohol without you knowing my exact date of birth? Ruminate on that for a minute, pause the video if you have to, and we'll get back to it a little bit later on. Now, I posed that question to you not to mess with your head because I feel like it, but because it's central to understanding how the Holy Grail of a scalable, secure, and decentralized Ethereum can be manifested, one that may use cutting-edge tech from Polygon, the 13th biggest blockchain by market cap, as part of the solution. But how are the two connected, and what's it got to do with buying wine? Well, that's what we'll find out today. Welcome to CryptoSnap.
The quest for the Holy Grail.
Let's start with Polygon, or the blockchain formerly known as Matic. The project came to life in 2017, created by 4 software engineers based in India. Its stated mission is to bring the world to Ethereum, basically help make Ethereum better. Because, in case you haven't tried to buy an NFT recently, ETH has some issues. In fact, most blockchains have issues, and it's partly down to something called the blockchain Trilemma. This theorem refers to a widely held belief that blockchains can be decentralized, they can be secure, or they can be scalable. And there are often 2 of those things at the same time, but it's incredibly difficult, perhaps even impossible, to be all 3 simultaneously. In Ethereum's case, it's pretty secure and decentralized, but it's not very scalable. And this, to get technical for a moment, is because to operate securely, very public blockchains have to rely on a widely distributed number of nodes, that is, computers connected to a blockchain network running important tasks like validating transactions. Such dispersed consensus building is slow, and so only a small amount of transactions can be processed in a given second on a very decentralized protocol. And that's why we get gas fees like the astronomical prices we saw during Bored Apes' Other Dudes minting chaos. People are effectively paying, sometimes thousands, to cut the queue and get their transactions recorded on the blockchain ahead of time. But there's only a queue in the first place because the blockchain can't handle the backlog quick enough. So gas fees are basically Disney fast track tickets to get on Space Mountain first.
40-minute wait.
Enter Polygon. It wants to help solve this issue of low throughput and the consequent high gas fees on the Ethereum blockchain. With over 1.3 billion recorded transactions, 130 million unique wallets, and roughly 2.7 million monthly active users, Polygon's proof-of-stake protocol is a very popular Ethereum scaling solution. Effectively, what it does is take transactions off Ethereum onto its own blockchain on the side, a sidechain as it were, where it processes them much quicker due to its proof-of-stake consensus. By processing batches of transactions quickly on its own blockchain, Polygon eliminates the need for Ethereum's current proof-of-work consensus to grind through all the data on its own. Polygon can then send the completed transaction data back to Ethereum like a zip file, and suddenly 1,000 transactions have been verified and okayed, but to Ethereum's blockchain it said like only 1 has happened. What a good idea.
Of course it's a good idea!
And the best bit of all of this is the gas fee for that 1 Ethereum transaction is split between the 1,000 transactions bundled in the Polygon sidechain zip file. And what you have to pay as a user is, say, 1,000th of what you would have had to pay otherwise. Oh, sounds amazing. But now there's another bit wobbling on our blockchain trilemma: security. The problem with sidechains is that you're entirely dependent on the blockchain you're splitting off to being secure and not compromised. If, for instance, it's actually really centralized, then those validators could effectively block or revert your transaction, what's known as a 51% attack, while it's on their sidechain, and you never get the funds back on Ethereum proper. You're effectively taking a risk every time you move assets off a secure, decentralized platform onto a more centralized or less secure one. And this is where Rollups come into play. No, not those sad-looking cigarettes and all those fruit things that I've never really understood. They're a separate blockchain and do largely the same thing as sidechains, bundling up volumes of transaction data into one easy-to-read Ethereum-ready zip file. But unlike sidechains, Rollups then asks for the parent blockchain, in our case Ethereum, to verify the validity of each transaction contained within it. Basically, a school teacher doing cursory register once the kids have finished screaming and throwing the books around and now quietly sitting at their desks.
Teddy?
Hey, miss.
As this transaction data is compact and more orderly, you can have almost the scale of sidechains while still relying wholly on Ethereum security. All right, now let's get back to that experiment, shall we? There were two ways the problem could have been solved. One, I can give you a fake ID with a made-up birth date. If, however, you learn it's fake, then you'll take the wine back and I'll likely lose all my money. This is how optimistic rollups work. They have a fraud-proving scheme/challenge period. If they prove that something's not right here, the rollup protocol re-executes the transaction. I can't get away with tricking you and I'll lose the funds, my funds. It works, but it's a kind of time-consuming process. You have to wait, investigate, and make sure I'm genuine. And then if I'm not, like in this case, we have to go back through the rigmarole of me giving you back the wine, and it's much faster for everyone involved if I can conclusively verify I'm of legal age up front without giving that information away directly to you. Here's an example of how that would work with the wine. This is Oleg. I'm going to show him my driver's license with my age taped over, and he's going to confirm whether it is indeed my license.
That's him.
Now meet Romain. Romain is given my license with everything else blacked out apart from my age. He doesn't know it's my license. He's been too busy developing TradingView's charting library to care what we've been doing over here in the content department. All he can see is the date before him, and he's asked to say whether that person is above 21. If both Oleg and Romain say yes, then you've confirmed I'm of legal age and can serve me the drink. But no one involved knows exactly how old I am, except for me. And all I'm saying here is I'm a bit like a fine wine.
It's all organic, right?
Yes, organic.
Good.
That was a very, very primitive example of a zero-knowledge proof, a way of verifying whether information is correct and accurate without knowing the full details of the information itself. It's thus a much more time-efficient way of validating transactions happening on another blockchain than optimistic rollups, which have their challenge period and fraud review. And unlike sidechains, it's still got the security of the main Ethereum blockchain. But they require a lot more computational power to execute and historically have been very difficult beasts to create. This is what Polygon has apparently cracked for Ethereum with the Polygon zkEVM release on July 20th. Their, quote, groundbreaking development of zkEVM is set to dramatically improve the experience of using and building with Ethereum by providing scalability and lower transaction costs, and it's an exciting step towards greater adoption of Web3 technology. It's allegedly the Holy Grail for making Ethereum scalable at an unprecedented level, and unlike others, it's fully compatible with every aspect of Ethereum technology, from smart contracts to development tools to wallets on the network. It's a big F deal, a PAS, although it has to be said one that's not currently reflected in the token's price, which, like the rest of crypto right now, is wearing a dreary shawl of market malaise. Okay, fine, the tech sounds sort of epic, but isn't Ethereum fixing a lot of these issues itself when it merges to proof of stake shortly? And wouldn't that make Polygon just redundant? The answer to both of those questions is yes and no. The Ethereum upgrade will do a lot of good stuff, like make the blockchain more environmentally friendly and notch up the transactions per second rate, but it won't change gas fees. I mean, Vitalik and his team aren't shouting this part from the rooftops, but it's literally listed as a misconception on Ethereum's website. See, the part that's supposed to dramatically increase throughput, that's transactions per second, and decrease gas fees is the sharding model, which basically splits the network into parts to distribute workload to offset pressure. But that isn't coming until 2023, and that's on Ethereum's time, which, as everyone knows, is longer than dog years. And while, of course, it's easy to imagine Ethereum might finally overcome its biggest weakness in gas fees in the long run, Polygon clearly knows this as well and will surely be planning for life after being an Ethereum layer 2, just like Saudi Arabia is planning for an economy after oil. Currently, Polygon labels itself as Ethereum's Internet of Blockchains. But a route it could take is to become something akin to Cosmos, becoming a scaling solution for multiple blockchains, or as Cosmos itself puts it, the Internet of Blockchains. Or it might do none of that. Polygon's job could be done and it might just simply pack up its bags and go home once ETH's power is strong enough. I think not, especially if you throw in real-world development like an integration with Instagram, an Adidas/Prada NFT collection on its blockchain, and most recently Disney choosing Polygon as the only blockchain to participate in this accelerator program. You get the vibe that this is a team that is developing both the capital and the expertise to expand its vision past ETH in the long run. In a nutshell, the longer Ethereum's scalability problems go on for, the more these alternative solutions like Polygon can flourish and grow into themselves and become their own little adults, ready to take on the crypto world on their own terms. What do you think? Let us know in the comments below, and if you're enjoying these videos, please subscribe to the channel. All your feedback and support helps us make better shows in the future. Until next time though, whether you're mainnetting, sidechaining, open rolling or zk proofing, always remember to look first and then leap. Cheers.